Capital. So let's get to it. Should be a lightning 15 to 18 minutes talk. I'd love to hear about the story behind the firm inception, around how it came about, and also kind of like the beginning story of you as an investor, but also tell us a little bit of the origin story of Jump Capital.
Sure. So thanks for having me. When you invited me, I thought we'd be doing this like as a Ferris wheel carpool karaoke thing, but this is just as good.
A lot better.
I co-founded Jump about a little over 10 years ago, and back then, if you just rewind the clock, there's a bunch of VCs I see in the audience. There was probably like 7 to 10 firms very active in tech investing at that time, based in Chicago. If you fast forward to now, the ecosystem is incredible. It's probably like 50 VCs, at varying sizes, different industries, et cetera. So part of when we started Jump, we were seeing a chasm or a gap in Series A, which our definition of Series A is typically about $1 million in revenue, usually looking for that's around $4 to $10 million in a check size. And when you looked around in Chicago, it was a lot of seed stage investors. So there was a gap after you raised that first round. Where are you going to get your next round? And again, if you rewind the clock back then, there weren't a lot of VCs from the coast coming to Chicago on a regular basis. It's changed dramatically in the last 5 years, I would say. So we were trying to fill that void. I would say 2, for us, we're ex-operators. So between my partner and I, we've started to run 6 companies. And our philosophy was we wanted to engage a little deeper than just giving a check and walking away. And as I joke, in the VC world, if you did a trade show of just VC booths, it'd be the same exact phrase, beyond capital, what else can I provide? We're here to support you. So we were theoretically doing that before, but I think what we try to do is fill a void on capital and then help with an operating lens. And then the last piece is we always wanted to be thoughtful capital, so we go really deep into areas, fintech, IT and data infrastructure, areas that we think that we can be a little bit more subject matter experts or at least additive, and then to be able to kind of have an intellectual debate with entrepreneurs.
You've mentioned fintech as and I'm curious, what's the size of the fund currently?
Yeah, so we're right now on our 7th fund. It's a $350 million fund. We closed that end of 2021 and have about 60 or 70% of that core fund to deploy still. Yeah.
So you've mentioned fintech as an area of focus. Obviously, that's a super wide area. And that's under a lot of pressure in this environment currently, to say the least. Yeah. Where are you still seeing opportunity?
Yeah, so within fintech, that's about, I would say loosely, about 60% of our fund or our effort. Within fintech, I would say there's a lot of pressure in the last 4 to 5 years. If you look back, companies that just took free cash and tried to deploy it on growth at any cost. I think that's almost a given at this point. Everybody knew that. So models that were really focused on customer acquisition, really spending a lot of money to go get new customers and figure out how to monetize them, really have a lot of pressure and issue. 2 is a lot of these business models required a lot of cash. And I would say that if you're a Series B, C, D, E, kind of company that is trying to raise money, incredibly hard right now. You have to be hitting perfection to raise that money. And so models that are a little bit more efficient, models that are typically B2B, I would say, or at least have a channel approach of efficient acquisition of customers, are usually the big ones. As far as categories, we see 3 trends within the fintech world. Number 1 is there's consumer behavior that's just radically changing. How they think about money, it's just accelerating at a clip where people are trying to get control of their own finances. And we think the RIA space really needs to be enabled with better tools to enable wealth managers and the like to have a better conversation. The second is, if you look at any industry, but I would say the fintech especially, the last 4 or 5 years, they just threw people at problems. So think of compliance. Compliance has been growing like crazy. They just throw people at problems, and so JP Morgan now spends $1 billion on just compliance, management. And then the third for us is compliance and regulatory. For us, that's a sector that, yes, you may be able to get efficiencies, but there is radical amounts of regulation and government oversight that's going to increase here. My general rule of thumb is when a macro economy goes up or down, usually something dramatic happens in the political landscape where they want to solve problems for people that were hurt by that. So we think that it's going to accelerate, and you're seeing it in the news every day with FTC, SEC, et cetera, et cetera.
And how's the current environment impacting the way that Jump is investing? I think.
You mean how are we? Like you mean the macro environment?
Yeah, the macro environment. Yep.
Yeah.
Yep.
So yeah, I would say that like the world was in 2021 was a little irrational, the FOMO, a fear of missing out, drove much of the venture industry. I think the last year and a half, especially last year, was like this digestion period where people were just trying to take their money and figure out what do I do with it. VCs were allowing their portfolio companies to do what they needed to, but to rationalize their spend, get more efficient, et cetera. I think we're kind of in that rationalization stage where all VCs, and I would use us as an example, we're very, very methodical when we're making decisions. Now, what does that mean? I would say that every deal that we've looked at that we liked, that we either wrote a term sheet or wanted to go after, has 3 or 4 term sheets. So what does that mean? That just means good companies are obvious. Ones that are not getting anything. And so it's a very have and have not kind of environment. We're in the middle of a term sheet right now, competitive situation. And just it requires you to be much more thoughtful of where you make those bets. But everybody's noticing it at the same time. So checks are being written, be more thoughtful. And our pace, I would say our pace is about half of what we deployed 3 years ago.
So let's talk about AI because that's on everyone's mind right now. It's funny, like 20 years ago, we was talking about AI with Allen Iverson, but now it's like a completely different. Few people got that joke, and it's okay. So let's talk about AI, not Allen Iverson. Where do you see the greatest potential disruption? Because like right now it feels like there's a lot of hype, a lot of trend, but what are you seeing as like a good for potential?
Yeah, I mean, when my son, my teenage son, has a chatbot in Snapchat and shows it to me, it's like everywhere right now, right? So it's kind of, I would argue that any VC, whenever I say or somebody says there's this company that does Gen AI, they roll their eyes. Like I think we've been in this hype cycle so fast that people are in the trough of disillusionment. We're really kind of at a point where we're trying to figure out where's this going to be used. So for me personally, I think there's a lot of really interesting public use cases, retail use cases, consumer use cases. But if you start going into the enterprise, we're super early, really, really early. People need to figure out how to do controls, how to put the governance around the data, cleanliness of the data, where's the data coming from, being able to understand if their models work. Just there's like this comfort that you need to have when it goes into a black box. And enterprises don't really have that yet. There's not the tools to do that yet. And if you're thinking about fintech, which I know this is more about fintech, in fintech, I can assure you they're not running it that hard. They may say they're playing with the tools, and they are, but I think it's more on efficiencies and less things on the front line of helping consumers. So you're not going to see a ton of chatbots out there. You're not going to be seeing like underwriting done by AI. Just those types of things are not going to happen in the near term because they don't have the controls and infrastructure yet. The second thing I would say, and just to be completely like out there, like I think white collar, low level jobs are in real concern right now, right? Anything that is mundane tasks, think of things in accounting, tax, consulting, you should be worried, right? Because you can automate a lot of those. Now it just means higher order thinking, critical thinking kind of roles, but just means there's going to be less jobs there, my personal opinion. And so then the third thing I'd say is, for me, like what I get really excited about is like where we invest, it's all the infrastructure stuff. And there's a lot of opportunities, but it's going to be the human enablement. How do you get them to feel like they're in control?
And can you quickly talk about how you're seeing any changes in your own portfolio companies around AI? Any?
Yeah. I mean, I just had a board meeting yesterday, and I brought up Gen AI, and I got a bunch of looks around the room, like, I played with ChatGPT kind of thing. So I think you have a spectrum of companies, even in my portfolio, that like, I'll wait and see, I'll see how this plays out, to the other end of the spectrum where they're, maybe even rebranding as a Gen AI company, right? I would say that we've tried to take a more thoughtful approach. We're trying to up-level my entire team to be really deep in it, because even if you don't invest in the space, it's going to be impacted. We're trying to coach our companies on how to use it to make you more efficient with your development, with your operations. There's a lot of tools to do those things. But I think the hard part now, and this is a personal view I have, which is buying versus building is going to be, there's going to be a compression in that. So maybe just put it a different way. If you're a strategic, if you're Microsoft and you would have bought a company, you're now probably going to debate whether to buy it or just to build it off of an open, kind of source platform. If you're doing market maps of areas, so say you're in fintech, hypothetically, and you do a market map, people that were in a box will now have the ability to jump boxes. And that brings a little bit of chaos, I think, to most companies. So we're trying to make sure our companies are being thoughtful of this disruption, the challenges of the competitors that can enter, be more efficient, and then, of course, just make sure you're aware of what's out there, but don't be running at it. Like I'm definitely one of those people that say don't run at it yet, because things are still forming and we're in like really early innings.
Shifting gears to more banking, as we're talking. This is more a conversation about the fin and fintech, which is finance. How is SVP and the regional banking crisis that occurred back in March, kind of impacting investing in Chicago, you think?
It seems like a long time ago. Yeah. Anybody in venture or a startup that had money at any of those regional banks probably feels the pain we did. I mean, we were knee deep in that. My first comment would be the venture ecosystem is built off of money. Shocking, right? Shocking revelation here. But the money comes from kind of 4 or 5 sources. One is venture capital. 2 is venture debt. And typically within that subset, you usually are getting the money from more venture funds that are forming. I can assure you there's not more venture funds forming, right? If you look out 2 years from now, I think there's going to be less venture funds than there are today. That's a personal view. I think part of it is interest rates are higher, the bar is higher to get returns, and so people have choices of where to put their money. I also think there's a lot of funds that were formed in the last 3 or 4 years that made FOMO type of investments. So you're going to see the good quality kind of separate. The third thing is like exits. You're not seeing IPOs. You're not seeing Google buy a ton of companies. And when you don't see the cash come back, you usually can't get people to invest in your fund. So it's a very circular kind of economy, if you will, in that way. So the VCs are slowing how they invest, as we've already talked about. If there's less funds, that also reduces it. On the banking side, there are a lot of new and or existing venture debt providers that stepped up to fill some of the void. But I would say it's very clear there's less money in that area. They're being tighter on it. They're not giving it to everybody. And so what does that mean? Just there's less money out there, which is, again, like anybody that's in this economy probably says, yeah, of course. Probably appropriate. But like when you go through such a drastic shock like we went through in March, it makes it more painful. Yeah.
So from a city standpoint, we're going to shift gears into like more Chicago. Your investors in LA, New York, and a bunch of other places, but you're headquartered here in Chicago. Would you have any thoughts about the current state of Chicago tech ecosystem? Like, how do you think about it?
Yeah, I mean, I love Chicago. I'm based here, of course. Most of our team's based here. I see a couple of them in the audience. And we have a New York office. So being a fintech investor would be impossible not to be in New York, to be honest. What I love about Chicago is most of the companies come with founder market fit, right? They usually come from like the transportation industry, they come from the finance industry, trading, they come from CPG, and then they build a company. I would argue that a lot of other areas, and it sounds like, oh yeah, of course, everybody should be doing that. That's a very Chicago thing. If you go down to Austin, if you go to Denver, we have investments in all these markets, so I'm a fan of all these markets in different ways. They're like different children or something with different love. But the difference is you find a lot of people building ideas and then trying to figure out where and what industry to put that idea towards. And so from my view, like Chicago tends to go start with the industry and the problem set and then build the company versus figuring out a cool new technology and figuring out where can I apply it. So I'm bullish. I will say that Chicago, when I talk to VCs, they're here way more often from the coast. They have portfolio companies here. And I would tell you that the best thing that could have happened to Chicago, which sounds ridiculous, is COVID. Like all the VCs on the coast started Zoom investing, and now they have board meetings here. And when they have a board meeting here, they tack on meetings with other companies and VCs, and so it's got a very circular kind of reinforcing mechanism. So I'm bullish. We have some pain in the macroeconomy, but I think it's better than a lot of other cities in the middle of the country right now, personally.
As we're concluding, one last question, a quick one. What's your favorite restaurant in Chicago?
What's my favorite what?
Restaurant in Chicago?
Oh, man. So maybe I'll give, you know where I went yesterday? I went to Armitage Ale House, which anybody that knows the place, like, I've been trying to get in there for like 3 months, which seems like lunacy, personally, because there's so many good restaurants. That was pretty good. So I'd put that there. I'm a pizza guy, so Spacca Napoli is one of my favorites. Yeah, and for me, I love Indian food. So one of the lesser-known Indian restaurants in Chicago is Vajra, V-A-J-R-A. Yeah.
I've never been to any of these places. I'll stop by.
That's what I'm here for.
Sach, thanks so much for doing this.
Yeah.
Appreciate you. Next is